Hello, everyone. This is Untitled from Sabancı Business School. I want to thank you all for joining our webinar titled Artificial Intelligence and Asset Management, which is organized by Sabancı University Center of Excellence in Finance under the sponsorship of Akbank. I would like to welcome Professor Jillian Grennan, who is joining us today from California. Thank you for being with us.
Thank you. I'm very excited to be here. And I'm so happy to be able to share my talk today on AI and asset management. By way of background, I am really interested in firms and how they create value. And as everybody knows, sort of technology has been pushing firms to adopt new strategies and to incorporate new methods to increase the value of their firm. But this also comes at a trade-off with workers and more traditional methods. And so what my talk today is going to do is it's going to really explore how we should be thinking about all of these aspects in the financial industry in particular. And so I'm really excited to be able to share that. And I want to note that, I'm excited for you to learn. I'm excited for all of us to do this. And so please share your questions if you have them in the chat. Okay?
Exactly. Our participants can type up their questions to the chat box, and I'll direct them to Professor Grennan in a short Q&A session after her talk. So, okay, thank you again, and we're all eager to listen to your talk.
Great. All right, let me share my screen and get the slides up.
Sure.
All right, fantastic. So this is on artificial intelligence and high-skilled work, but I'm going to, within the talk, give an overview of artificial intelligence in the asset management industry, as well as sort of how it's playing a role with analysts and other investors. And then ultimately, we're going to sort of show our results from this particular paper. As a way of background, technology has really been at the forefront of many changes for years. And what is so cool about AI is that it's really the general purpose technology of our generation. That is, it's like the steam engine. It's something that's going to bring in widespread change throughout industries. And if you think of the steam engine, this is really what brought us new supply chains. It allowed us to do so many different forms of businesses. And so what's exciting to me is that we're rethinking about how businesses can be formed. What is the new business model going to be? And a big core part of that question is, how are workers going to interact? How are we going to enable the workforce to be stronger and more vibrant because of this technology? We want it to augment the workforce, not necessarily just replace the workforce. So with that, sort of what I was saying, what are those motivation that I have is that AI is just such a powerful form of automation. What it does is to improve prediction. And then sort of this extra part is to act more like humans. And so this is where the definition has got a little bit controversial, and people are saying, oh, AI is going to replace humans. We have to remember that AI is a little bit different in the sense that it's a bunch of prediction models. And so it's taking information in a very different way than the way you and I would maybe pull information from a conversation with a friend. Okay. And then you have to think about the applications. They're not just in finance. I think finance is sort of at the cutting edge because finance had always been built upon information. And what's also even better is that the pandemic, it may have just accelerated this trend even more. 2020 set records for AI investment despite the pandemic. There's 68 billion privately invested in AI, and 1 in 3 CEOs that were surveyed indicated that they increased investment in AI last year. And for many of them, this might have been the first time they actually put money towards it, where they were saying, we're going to see this change. And I recently just heard and was reading a little bit more on work from home and how much that's went there. Basically, every VC out there threw money at work from home last year. If you think about the VC cycle, this means 5 years from now, we're just going to have just so many more capabilities there as well. So the emergence of AI raises questions about the future of work and what it'll look like. Well, I was talking about the steam engine and recognizing that we've had other technological waves. We've had the, internet came about just 25, 30 years ago. So we've had these changes, but these changes might have been different. A lot of people think of them as capital deepening, That is, they bought more machines. They did sort of things that displaced low-skilled workers. Whereas AI is different because we think of it as maybe instead of capital deepening, it's actually deepening the labor component. And so maybe it's going to augment us, or it could displace us. There's just a lot of ambiguity, and it's something that people are curious to know more about. So I pulled this quote from Joyce Chang. She's the head of global research at JP Morgan. And she said, with 80% of the data in the world created in the last 2 years, judgment matters more than ever. Technology is a complement to sound judgment, and knowledge, not a substitute. And I think that this idea, this tension between complements and substitutes, is exactly at the heart of what everybody wants to know. So our question is, given all of the changes in AI and big data, especially changes that are automating core production tasks, and I'll talk about that a little bit more, what are the implications for incumbent workers who might have been traditionally working in this space? I was a consultant before. I crunched the numbers. I think a lot of people out there who are analysts might be like, what's going on? Maybe they're already working with this data and they're curious about what the future holds. So we're going to really focus on stock analysts today and talk about the forecasting and how AI might change or not change their job. So just to preview some of our main findings, AI does not fully replace analysts, but it does change the job. And it's actually reducing the total number of analysts. You might be like, this is great. Why does Facebook need so many analysts? But it is changing it. But what we're seeing is it's more, in some sense, might be a better allocation. And I'll explain that a little bit more. So we see fewer analysts per stock. Some are leaving, fewer are entering. But what we're seeing is those are shifting their stock coverage actually to ones that require social skills, or what you might think of as your ear to the street. If you're an analyst, there are information that you could only get by talking to management, by talking to other analysts, by paying attention to what's going on Wall Street. And so I think that fact that these might have been mid-cap or small-cap stocks that maybe didn't get as much attention before from analysts and are finally getting attention could be a really good thing. So there is a complement. So what we're seeing is analysts are turning to this soft skill, and they're increasing their meetings with management and institutional investors. We also interestingly see that they're changing the type of questions that they ask on earnings calls. Finally, we're seeing prediction quality change. So at the end of the day, one of their main tasks is to forecast earnings. And we're seeing a change in response that seems to suggest that they're increasing a little bit of effort, but perhaps more than that, just it's helping them to become more accurate. So let me go into the background on AI and asset management now. I think it's a really exciting time to be here. And this is because investors are using AI now to do what analysts used to do. So there's a rapidly expanding set of fintechs synthesizing many data sources and using AI to make investment recommendations. And so at first you might have thought of this as weather patterns or Twitter posts or people I've seen do analysis of music. There's just so much data out there that they can extract what is valuable information. And so this was from 2020. I like these graphics. They put them out every year about how much data there really is. So there's roughly 42 million messages shared on WhatsApp in a single minute. If we think that there is crowd wisdom or there's some portion of information out there that you could use, then this needle in the haystack problem, as some people called it before, it's become massively bigger. How are you going to find that one piece of information that might be valuable? And so for this reason, a lot of the theorists, and I think there's great work to be done by theorists here too, are looking and thinking about the microstructure in more detail and saying, wait, is it going to be just data mining? This is going back to some fundamental questions, and it's useful to take that perspective as well. So all investors, they need to rely on AI to process alt data. And so this is an example from a company called TipRanks. And they're a company that we are working with some of their data for our project. And so they have a bunch of different data sets, and they basically mine the data to come up with what these are the 8 core factors that they talk about. The analysts, the bloggers, the hedge funds, the insiders, the investor community, so that's sort of the social media community, news sentiment, all of this stuff. And what they're doing is generating it into a smart score. So this is an AI-based score. And I don't put up their numbers, but it has, even despite the pandemic, continues to just massively outperform. And it's not just their algorithm. I've seen many other talks with algorithms that people are coming up with, that you're getting a better Sharpe ratio. You're just doing that much better when you incorporate AI. What I liked about this one in particular is that they're looking at alt data and a lot of other sources. And so to talk about alt data and AI, this numbers, I have not seen them updated, but the total buy side spend was very massive and continues to increase on alternative data. And then you ask yourself, what are they using? And this I've heard time and time again from analysts in different communities. We're getting web data, a ton of it's being scraped. Almost everyone now has access to the credit card data, but you might still have access to other data that other people are interested in. Surprisingly, less people using satellite than I have heard, as much as it was hyped, but definitely the geolocation data. I've heard a lot more about people using this, especially in the pandemic world, where we want to know, how quickly is the economy going to come back. So what do I think are the factors influencing AI adoption? There's a lot of factors out there. Data abundance is a great one. So there's more things to be quantified. And that was what I was sort of pointing out with this data that people are buying. And I was on a panel with a hedge fund guy who is saying he's literally pitched an alternative data set every single day. So understanding what data is out there, there is just so much. Computing ease, though. Data processing is just so much less costly now. And so a lot of people can build it out, okay? You don't need the processor power that you used to need. NLP is just that much better as we get, different people have put their stuff out, the GPT-3, just the massive success, but also the fact that it's become more accessible. So what I'm saying about accessible down here, that actually I sort of jumped into it. There's so many more open source AI tools. Think about GitHub, think about PyTorch, think about how many things that used to be built in-house that aren't. And so it's less costly and there's less reliance on firm-specific investment. When that happens, that means that a lot of people can use it and adopt it. Other one is the algorithmic improvement. So it's easier to train models, especially for stable results. So some of the problems initially in AI was you might train a model and you're like, this is great. But then if you went and retrained your model to update it with data a month or even 3 months later, you get very different results. And so stability has massively improved, which is good. Data integrity, it was on the same panel I was with the hedge funds. The guy was telling me that this is actually what they spend too much of their time on, that it is still a process and you don't want garbage in, garbage out, as they say. If you're not using high quality data, your prediction is not going to be a high quality prediction. Okay, so they said that actually they spend more time on the data integrity than they do on improving their algorithms. And then finally, competition. It's not just the incumbents anymore. It's not just the hedge fund guys doing this. There are a ton of startups out there that are trying to bring products to market. And it's actually interesting to see just the interactions between the two sides. I think in Robinhood's IPO, some people were sort of talking about their relationships with Citadel and different people, but there's definitely, even our company TipRanks that we're working with, they have relationships with hedge funds that they're creating custom stuff for. And so I think this sort of teaming up is really exciting and could bring benefits. So fintechs and AI, they are changing asset management. You're like, great, you're telling me all this, but what has happened? So there is research out there that has shown that they're bringing valuable information. So price informativeness, I think, was what people first started looking at, but also informational speed. If you think about trading, you need to both have the right information, but you also have to match with the traders. We're seeing informational speed improve. It also, and these are sort of more what I would call discussion topics, AI increases prediction confidence, which we know, but it reduces the residual variance. And so there's some people out there, if you talk to them, they think that what's been going on with the meme stocks is really just a lot of this AI, that basically when everybody uses it, you're going to get this general equilibrium effect, whereby, we could have been in a no trade future, but we've now been into a future where you get this unexpected variance. Perhaps somebody's talking about a really popular meme stock out of nowhere, and that variance is now the big variance in the system, and so you have to adjust to that. Okay, so with that, I'm going to turn from sort of AI and asset management and hopefully give you an overview of why it's getting adopted and what people are looking at, which is a lot of alt data, and to focus on the other side, to look at the high-skilled work and the people who had traditionally been analyzing the data. So how is AI's impact on labor potentially different? So robots, they're sort of, you go back in history and you look at what you've seen and you use that as your sort of guidance and your source. So they traditionally substituted for manual tasks, but only up to a threshold. So you might got rid of the person who was moving boxes because we now have a crane lift that can move them much more quickly. And then you just reskilled that worker. So this is the warehouse robots and the cleaning robots. Much of the benefits actually were saying, okay, now that because they saved costs, they were able to invest in other places, and this really did improve the economy. So that's a lot of the work by Asmogel and Restrepo. Software was a little bit different. If we turn to that, that's substituting for routine back office tasks with low stakes. So this is more medium skills, I would say. Think of this as billing software, okay? And what you saw was this sort of capital deepening. This was where, the stakes just weren't there, especially think about advertisement, because I think advertisement's always another great example where, if you get an annoying advertisement, it doesn't bother anybody. It's fine, you keep going. And so only more recently have the advertisements that sort of come up on our computers actually gotten better as people have more data on, who we are as a consumer. AI, though, what's then different is they're going to substitute for sort of high risk or high stakes, non-routine core production tasks. So this is the image recognition. So this is what doctors did. Where is there actually a problem with this medical system? And stock predictions. Again, if you're putting millions of dollars behind something, you better be pretty accurate or convicted on your investment. But also other things like writing reports. As the natural language processing has gotten a lot better, and so they can predict the next words, they can actually write things. While they don't think about it the same way we do, their ability to predict the next word based on a set of words is rather phenomenal. And there's a related paper that I quite like where they've looked at, basically AI-based analyst reports versus real analyst reports and had people read them, and you really can't tell much of the difference. And because I've looked at this, I get all these ads that tell me to go look at these fake reports, and they are really striking. So what do sell-side analysts traditionally do? They have a mix of roles. I think of them when you talk to them, they're like, oh, we have this fun stuff and we have this routine stuff. And the routine stuff is sort of, yes, they have to be on earnings calls. There's a time period. You have to update your model. You have to put it out. You have to put your estimate out. They also have sort of more standard research reports. But what they're really going to get their money from is these deep dives that they do, okay? And these deep dives are the ones that typically come with a recommendation, okay? And it's their unique insights that they're bringing. So they're going towards uncovering new information or proprietary angles. So if we think of now all of this data that's out there, this abundance of data, somebody was bound to say something on Twitter that was just as smart as what the analyst was going to say. So it basically has made it much harder for the analyst to uncover new info or new proprietary angles. Okay, and why is this important? Well, it's important because you have to think about the analyst job. They're typically a cost center, especially in the US for firms. Their employers, the big banks, only profit indirectly from them via the trades that they bring in, okay? So their compensation is often related to this abnormal trading. How do you get abnormal trading? Well, that's basically when the clients, they appreciate your soft information gathered. They appreciate your access to management. They know that what you're doing is really giving them a valuable insight into the firm. So what tasks that analysts do can machines do? There's this great paper by Brynjolfsson, who they came up with a suitability for machine learning index. And what it does is it takes every job that's listed in the US in terms of the Bureau of Labor and Statistics, and they go through the description and they determine how much it can be replaced by AI. So analysts' jobs are considered above average for replacement, which I find fascinating. So they're just, the system that they created already said that. Great. So what? Why? Well, analyst tasks that AI can do, first one is processing data. They're going to be so much better at processing data. But what I point out here is this short-term predictions. A lot of people say AI is really good at short-term predictions. It can't predict the long-term future. So, it's figuring out this trend, and it's a local trend that it's come up with. They're really good. You can automate how you update your valuation models. You can even write these reports. What are the tasks that they can't do? So while people have been starting to work on the economic interpretability of predictions, that is just still a big challenge. I've read some of them when they try and take an AI model and project it back. They're just not there yet. Same thing with the knowledge of long-term trends. Long-term trends, we've just not seen AI be able to predict these long-term trends. And so, if AI would have worked in COVID and the risk models wouldn't have broke, I think everybody would have been super excited and the whole industry would have changed. At this point in time, they did not do it. Nobody did. So, explaining the findings to clients, gathering information, and basically having some human interact to come up with the risk parameters is probably what's going to happen. So those all turn into our testable hypotheses, which was substitutes. Are there fewer analysts, more analysts? Can we decompose it into quitting, entering, changing stock coverage? Complementarity. Whoa, you did do some stuff for me. Does it free up my time? What can I do with my time now? What is my best use? Maybe my best use is putting my time towards my clients. So we look at that angle. And then this is asking about the product quality. And finally, a little bit on their compensation, because a lot of people worry that, well, if AI can do it and I'm competing with a machine, and machines are relatively cheap, then I'm going to lose some of my earnings. And so we're going to look a little bit at that question. So before I get into the rest of the stuff, I do want to give you some of the anecdotes, because I think this stuff was just fascinating. So Ronnie and I did a series of interviews with analysts that are currently working out there to get their perspective on AI, basically to confirm some of our thoughts, but also to think more about the future. And so I'm going to just give you some of the highlights from some of these questions. So has entry into and exit from the job changed as a result of AI? Perhaps out there you're thinking of going in to be an analyst and you're changing your mind. So we have heard resounding yes on both the entry and exit. Yes, brokers seeking atypical backgrounds now. They're looking for people in tech. They're looking for people in healthcare. They're looking for people who are different. So the Wall Street glass ceiling, this idea that you needed to go be an investment banker first, and then you waited for somebody to die because an analyst job is pretty great and people keep it for a long time, that is not there. The Wall Street glass ceiling is broken. So what about on the exit side? Again, we were saying that these might be substitutes AI might substitute for analysts. Here we heard again that AI is changing things, because every company now seems to be, adopting tech or adopting some e-commerce angle. And so analysts get exposed to aspects of business outside of what might be their core industry. It's not just covering energy industry anymore. It's not just covering shipping. And so this opens doors to opportunities in corporate roles or in investor relation roles, rather than just going to, say, the buy side or doing some other analyst role, which I found all this interesting. So they think it's definitely changing this dynamics of going in and out. So then the next question we asked them is, well, how is it changing the job? Is it changing the nature of the job? And they said yes, but they said there's more nuance. And so here they were really made this distinction between, and multiple analysts made this distinction between mega large cap stocks and sort of small and mid cap stocks. So they suggested that AI is pretty accurate at prediction for these stocks with a few well-established metrics that everyone has the data for. So this is the insight that, you're going to predict the sales of Walmart, and it's about plus or minus 3%, and it's not really changing much more than that. There's also a totally different side, which is this small and mid-cap stocks, and they contrasted them quite a bit. So small and mid-cap stocks, what you're seeing is a bunch of data points that are not filled in. Okay, we don't have the information on it. It's hard to gather the information on it. Maybe it's the alt data providers are not, trying to get their startup off the ground, and so they're only doing the 100 biggest companies first. Whatever it is, the data is not well populated. And then remember when I was telling you the hedge fund analyst spends a lot of time thinking about data integrity? It's not high quality either for these small mid-cap firms. So this is where there's opportunity, clearly. Okay. But what they said is that they also think that the valuable insights on these companies really aren't things that are expressed in terms of data. They're insights that come from sort of the analyst's ability to have, legwork. For the pharma companies, think of how many different pharma companies out there that were all competing sort of to come up with these vaccines and different stuff. It's really about the insights and the knowledge and knowing the scientists and knowing the potential price setting ex post and these sort of types of scenarios that help you really be able to predict the right winner out of a set that might all be competing. So interestingly, because I had said that there is a lot of evidence that AI is much better at shorter horizon forecasts than at longer horizon forecasts, I asked them if AI is pushing forecasts to shorter or longer horizons, and I resoundingly got a no, where they said that forecast horizon still just depends on who your clients are. And so if your client is more of a long short fund that has an investment thesis of 2 years, then you're writing it at that horizon versus if you're working with other clients. So will AI replace you soon? And this one where I thought we got more mixed answers, and this is one that's really funny to talk to them about. So I love this where somebody's just like, no, it's not going to replace me. And autopilot never replaced pilots. It just changed their job. Okay, and so I think that's what the takeaway from our stuff today is too, is that it's changing the nature of work. So be prepared for change. And then I thought this one was a really nice answer because it was sort of hinting at what we're hinting at, which is AI is complementary. And this person said, AI may set our risk parameters, then our ear to the street will help us pick between 3 AI selected mid caps. So this person really thought AI is going to narrow the set for us, and from there, this is where our value add comes in. And so I thought that was a great description of how you could see this complementarity between them. So I've told you what the analysts have to say. What does the data actually say? This is a one-off, people. Remember, sample size n equals 5 is not going to be representative of the whole population. And so this is what we set out to do. We set out to go and look at all the data that's out there and say, what can we learn about this? So how are we going to proxy for AI in the analyst context? So this is a tough question. There's a lot of things that involve AI. Okay, so we're going to do it in multiple ways. The first way is to look at this data abundance aspect. Okay, we're going to look at the number of posts to social media for a given stock in a given quarter. So the ways you can think about this is Apple, Facebook, and Tesla get disproportionate attention. We can add GameStop and AMC there. It's much more even than household names, perhaps like Coca-Cola or Starbucks. Okay. And remember that data abundance matters because it's that crowd wisdom that the analyst has to compete against in terms of sort of this proprietary trading angle. But it's not just about data, so we want to think about other aspects as well. So we're going to think about computational ease. Here we're going to use the fact that the SEC records the identity of anybody who downloads an SEC filing. Okay? And so what we can do is go through these are massive data sets just for a single day, and identify from the IP address, those that are basically crawlers or those that are, bulk processing data. Okay, and so then this gives us a proxy, at least, on a quarterly level of how much, those who are really good at computational ease are looking into these stocks. Finally, we can proxy for the remaining AI using employer investments. So here, I know some people have, it's been interesting too, if you even read some of the, like RBC has really, Royal Bank of Canada has really went up the ranks recently from Institutional Investor magazine in terms of their analysts, and they also did a lot of investment early on in fintech and AI. Okay, so we're looking at it in 3 different ways. So we're looking at your investment by buying sort of fintech or AI firms, but we're also looking at data licensing. And I just did not understand how much data licensing was going on out there. Facebook licenses its data to over 75 firms, including many of the big banks. Okay, so these are the sort of proxies we're looking at. So just to give you some baseline conditional correlations, what we're seeing based on this data abundance, this number of social media posts, and here we're just looking at the total number of analysts in a given quarter, what we're seeing is there's a decrease in analysts when a stock has more data abundance. We also see a decrease in analysts when it's easier to compute. That is when there's more crawlers downloading their 10Ks. We're putting in a bunch of controls and fixed effects. So when you think of stock controls, what are you thinking of? We're putting in what you want, the momentum, the volatility, what else is going on with the stock, how many news stories were coming out about the stock, how much analyst coverage does it have, or how much other information is out there. We're also putting in time fixed effects. Putting in industry fixed effects, you might say, like, look, everybody covers retail, nobody covers energy. Okay, and then here we're even putting in stock fixed effects. So we're saying, let's just look at the specific stock over time when we see more variation in these proxies, what's happening, and you still see the effects there. But this is just a baseline correlation, and everybody wants to do better. A lot of the economics and finance profession is saying, can we get a causal estimate? And so we have an instrument. Okay, our instrument's going to be for data abundance. So think of this: short news headlines attract attention, ultimately leading to more social media posts about a specific stock. Okay, so you can think about this as like GameStop. You had a bunch of news on it, more people saw it, more people piled in to write their own comments about it. Some of these, which we know from prior research, are valuable. There is price informativeness, crowd wisdom does bring out valuable insights. And so what we're really doing, and why is headline length random? Headline length is always random because of advertisement sales sold. So if the advertisement is a bigger space, you get a smaller headline. If the advertisement sold as a smaller place, you get a bigger headline. So there's always this reverse relationship. And one of my colleagues, I'm visiting UC Berkeley right now, and I was talking to him about this paper, and he was telling me, he's the deal book professor, if you've ever read the New York Times, and he was saying that he has never been able to select his headline, much to his chagrin. And so I do think that this is very true. So then the question is, why are we using this headline? Well, it's sort of an awesome tool to separate out the good, this sort of random variation, from the bad, which is, data abundance is not only going to be occurring because of headlines. It might be about the informational complexity of the stock, and you have to know a lot of information. And so this is what we're trying to account for. And this is just to show you, because I wasn't fully convinced, that the major headlines, so this is from the Wells Fargo scandal. This is a short one. Wells Fargo gets the heat. Wells Fargo is fined for sales scam. All the way up to this one, which is, as you can see, much longer. This was the Washington Post, though, who obviously didn't sell a lot of advertisements, say Wells Fargo fired 5,300 workers for improper sales push, and the executive in charge is trying with $125 million. So there was a lot of variation in headline length, and so we were able to exploit this. So let's get into the results and see what the sort of big full data set has to say. So this is using our instrument, and we basically see the same results. Fewer analysts per stock when social media data is abundant. The point estimates are not that different, so this is also gives us like confidence in our estimate. We also see, the F-stat, everything that you'd want to hear and know about instrument, it's good. And as I was saying, we can control for 20 plus stock and news characteristics. So we're feeling confident the analysts are leaving. The next thing we want to do is decompose these leaves into understanding if it's just people aren't being hired into the profession, or if it's actual quits, or what's going on. And so we first looked at quits. And what I think was really interesting here is that there are quits, and especially amongst accurate analysts. So we look in the previous year, if you were in the top quartile or the top decile, doesn't really matter how we define accuracy in terms of a breakdown, but it's the very accurate analysts that are quitting. And this to me is fascinating, because these are people who probably had a technical advantage, or they had some type of advantage. And we're going to look at this a little bit more, that they just wanted to leave. They didn't want to be a part of the profession anymore. Maybe they saw the writing on the wall. Maybe they thought that their technical talent could go elsewhere. Okay. We see easy computation, sort of very similar. So the fact that it's easy. What I think is interesting, though, is we do see the opposite side, although the magnitude is much smaller, of this AI data acquisition. So this is telling us, to some extent, when the firm does invest and sort of say, look, we're bringing in-house this team that's going to be our data science center. You know, UBS has its famous data intelligence center. Analysts are less likely to quit, but it doesn't. All of these are standardized, so you can compare them. It's sort of certainly not as big as about 20% of the effect of data abundance. Okay. And so you might naturally ask, well, is this rate higher than in the past? And it most certainly is. So this is the rates over time, and this is a fitted line, so you can think of it as similar to the regression evidence. And what you're seeing is that the analysts quit and leave much more, especially the highly accurate analysts. And obviously this dip is sort of during the financial crisis, where people maybe didn't want to leave their job. Okay. So where do analysts go? And so we've done a random sample of about 900 analysts. We looked up their LinkedIn profiles and we searched them to see what's going on. And so they're going to the buy side. They're going to corporate finance. So just as sort of the interviews we had heard, this was a little surprising to us to see 16% going into a corporate finance role. We looked at fintech and entrepreneurship. Together, it's collectively almost 15%, but I actually thought it might have been higher. What I was really surprised by was this other 10% in investor relations. You would have never heard of an analyst going to investor relations, in the early 2000s. Okay, and so the bottom line is talent's leaving, but many are also staying in a research role. And so what we did then is to sort of divide these titles up into basically buy-side asset management research roles versus non-research roles. And we find that, yeah, they're not going into these research roles, they're going into these non-research jobs. So they are going into this IR, corporate strategy, consulting type of stuff, more so than they were in the past. Okay, this is the one. So we were telling you this hypothesis about maybe it's the guy who was really technically good, who sees the writing on the wall and jumps ship, or whereas like the other people might not see this. And so what we did with the same LinkedIn data, we looked and we found it actually seems to be that the non-MBA socially disconnected analysts are leaving. That is, those with the MBA are likely to stay. But remember, when you get the MBA, what you're really getting, I mean, I always put these prompts for my students. I tell them, let's network, let's talk, let's learn about each other. It is really about that network you leave with after the MBA, and those are the guys who, have a better ear to the street, who maybe are able to talk to management better or have more contacts in management who were contacts from, previous times together. Okay, so I think this really is a resounding, maybe we are shifting who exactly is good or will be the best at the analyst role in the future. So AI and analyst next job, I'm just showing that when we do run the regressions, they are there. The fintech is not. So then this is where, so those were sort of the external. So remember, we see analysts fewer per stock. We saw some of them going and leaving the job. Now we're saying, okay, if you stay, maybe you still don't like all of the competition from AI. What are you doing? Are you changing the stocks that you cover? Okay. And so we do see when we look at this intensive margin, that is their stock coverage margin, we see that analysts are less likely to initiate coverage on stocks with high data abundance. Again, this has the full set of controls. And it doesn't matter if we're doing it with stock fixed effects or if we're doing it with analyst and industry fixed effects, it's going through, okay? We also ask the same, so this is about initiations. The flip side of it is saying, who are you going to stop covering? And here we see analysts are more likely to stop covering stocks with high data abundance. So this is, we're leaving Facebook, and maybe we're going to pick up a smaller, lesser known tech company, okay? And I think that's very useful if we think about this, as we've always struggled with getting, coverage for small and mid-cap firms. So as a summary, we see that AI substitutes for high-skilled labor. We see career switching, especially among top talent. We see stock coverage move away from high AI stocks. And this is consistent with a rich literature on other tech, okay? That there is this element of substitution there. One of the things I think that's really fascinating is this prior literature had nuance in it. There was early adopters and non-adopters. So basically, if you were the manufacturer who was the first to invest in robots, you were awesome, okay? Basically, talent reallocated to you, all of these benefits accrue to you. With AI, what's very fascinating to me is we're a little bit seeing this with RBC, maybe, and UBS, who are not top banks, originally are not the top one or two, but a lot of their competition is coming from startups. And so, they have to adjust to this external competition. They don't have a choice anymore. And so that's what I think most fascinating is it's going to be a system-wide change because of this competition. It's not going to be a first mover advantage. Okay, so now I'm going to move into this testing complementary task hypothesis. I'm going to go a little bit quicker because you sort of have seen the framework. It's the same framework as before. We're just introducing new data. And what data are we introducing? Hard versus soft skills. So this is a really cool novel data set that we're going to bring in, where we are able to get time use data for analysts and what they're spending their time on. Are they spending their time with management? Are they spending their time in meetings with clients? Are they actually spending their time on core, report writing, earnings forecasts, model updates, that type of stuff? And what we find is that it's all about the soft skills, okay? And I think that's really fascinating. This goes to the same MBA. We're keeping the MBAs there. So we see it in two ways. First, we looked at earnings calls, and we saw that analysts were asking questions that changed. So first, they asked more questions, although that can sometimes be based on the time allocated. But they were also asking more complex questions. Complex questions are based to the number of words in the question. But then what the ideas were. So we divided them into harder to measure versus easy to measure. So you can think about easy to measure being things like sales, things like, profits, things like that. Basically AI has been shown, because of whether it's satellite imagery or it's available data and that's high quality, we're really pretty accurate at predicting sales in the short term. They're asking about questions about sort of user engagement and culture and more of the intangibles. And so this difference also sort of speaks to the fact that maybe that's what AI isn't really good at measuring. Then we look at their time use, that I was saying, this really cool new data, and we see that it most certainly shifts to more meetings with management and investors. And this was another interview question that I asked them just to try and get a sense of, and I always heard the same thing that somebody was telling me, it's the most, even during COVID, FaceTime he's ever had with clients. And he said he wasn't sure if it was Zoom or what it was, but everybody wants to talk. And so it sounds like this trend just continues to occur, where they're spending much more time sort of holding the hand of their investors. And especially, I think with AI, you don't want the black box. It's not good at economic interpretability. This is where the analyst role comes in. AI is associated with improved product quality. So we looked at sort of the bias and the accuracy of their earnings forecast was the forecast the same as what actually got reported by the company. And we see that there's some improvements, but there is also large heterogeneity. Remember, we told you the most accurate people are quitting. So if you divide it up into the distribution, we don't really see improvements across the distribution. So it seems like there's some improvements, and we're trying to do more to link this up to perhaps the soft skills, but it's not totally there. But we think all of this speaks to this idea of at least analysts, AI is going to also complement them, and it's not a bleak future for analysts. Their job is changing. It's an exciting time. They have different skills that are going to come to the forefront. It's a job that you can go into as an MBA that you don't necessarily need to be the best at your technical skills. It can also be somebody who is really good at asking the right questions. And, questioning why is a talent. It also supports the increased importance of sort of these EQ, these non-cognitive skills in the labor market, which there's been a just growing number of papers suggesting social skills are becoming very important. And so maybe what you're looking for, if you're trying to hire an analyst, you're looking for a person who played a sport, or you're looking for a person who is a leader in their group. So this is the last one, sad-looking work-from-home guy. The implications for compensation. So this is the one part where it is not the best story. So while compensation data is not totally available, we do know that their incentive pay is linked to direct trades through their employer. A common proxy in the literature is to look at excess returns and excess trading volume around analyst announcements when they upgrade to a buy or they downgrade to a hold. So something that would clearly lead the market to react, how many trades are then being shifted through your firm. And what we see is actually, lower excess trading, lower excess volume. All of this suggests, and this is with time and analyst fixed effects, so this is literally you were covering Home Depot, and Home Depot, all of a sudden we've gotten way much better data on lumber and housing and stuff, and we're going to know what's going on with the consumer. Now your data abundance stock, same thing. Home Depot later, when you put out your recommendation, people aren't reacting to it as much. Maybe that information already got incorporated or is already out there because of Twitter, because we know that people are, putting their pictures of their new home improvement projects out on Facebook. Okay, so this is sort of consistent with at least less stuff going through your house or going through your employer, and so therefore you're getting less compensation. So finally, in the last sort of 2 slides, and I do promise I know I've covered a lot of content today, but I appreciate you sticking with me, that the broader implications for high-skilled work. So if AI can only substitute for certain tasks, so those that, are computationally easy, then it may need to change your jobs. And I think this is really important to think about. UBS and other brokers recognize this, and they've created these intelligence centers from which analysts can collect the pre-processed AI data. Okay? And so what they're doing is really spending their time on these social aspects, or their ear to the street. But then this brings a question about assessing effort. Okay? Data and sort of some of these routine tasks that we're keeping in, those are ones that, your pay should be set at a very flat rate because it's very routine. When we think about making the recommendation or what you got by the legwork on the street, these are things that are exactly what the salesman does. These should be high incentive pay, okay? And so what this is suggesting is we might have to really restructure compensation contracts, especially if we want in the future to get the best effort out of employees. And so in conclusion, we asked what AI is doing to change industries, to change incumbent workers, to change those traditionally tasked with AI work. We focused on asset management. We did a deep dive on asset management. We know it's being adopted. We know it's changing markets. We know it's changing markets ways that we might not even fully understand yet. And what did we find? we found that, equity analyst job, the nature of it's going to change. Okay, right now we're seeing some people leave, really talented ones, but we're also seeing them hire people who might not have had a traditional background. Okay, some of these talent offsets might be offsetting, their forecastability, but ultimately we think that this is going to improve things because, when they do have access to management, and maybe AI can direct you into a limited number of stocks, they're better able to pick amongst those because of their soft skill advantage. And so what we would argue is that, the person who might be best suited for being an analyst is also changing as the nature of the work changes. Okay, it's not just about the tech person anymore. It's going to be about a person who has social skills. And so the limitation of this is, of course, I would love for it to generalize, and I'd love to be able to tell you what's going to happen across many different industries. But it's self-site analysts. It's very particular. Okay, and so it might not generalize. But with that, thank you for allowing me to share my insights, and I'd love to see if you have any questions, or I'm happy to pick some that I think are useful to talk about. Okay.
Thank you, Professor Grennan, for your talk and sharing your views on the expanding role of artificial intelligence in asset management. I can ask you a couple of questions myself. So, like one analogy that came to my mind is in the 90s when internet became more widespread. There was this talk about much easier access to information, but now years later we see that disinformation is very prevalent. So do you see any dangers that artificial intelligence can bring to the business of finance, for example, in terms of information production? Or maybe manipulation of the existing info, like practices like spoofing. Like, how do you see those aspects?
Right. So I actually think that this is a place where AI is becoming increasingly better at it because of the reinforcement learning and the fact that you can have one work off of the other and try and predict where it's wrong. I do think that that in itself is going to be helpful for getting us higher quality data. I think what you're trying to ask is the same question of the needle in the haystack. We got this information flow. Now we have fake data. Now we have bad things. How do we find that one right person? And so I really like this theory work by D'Agusta and Foucault, that they were saying that basically you might have this thing where you take an earlier signal because you used to be able to search a lot bigger space, and now you're like, oh well, I think that this is a high enough quality one. I'm going to use this information. But even when that happens, what you actually do get is more accurate prices initially, but what you actually see is sort of a decay in the long term. And so this is something I do wonder about, how long term it's going to go. And then sort of what you were hinting at, and I might have mentioned just briefly, is we have to think about the risk. A lot of investment strategies do rely on diffuse risk. And so, the fact that AI might be narrowing the risk pool then says, okay, we're going to have to change some of the products, whether this is insurance, but think also about hedging strategies. This might totally change the way we design, contracts for hedging. And so I do think that there are going to be these next wave of things as the first wave's gone through and people are like, okay, let's rethink about it. So do I think that we are still in a fragile state? Certainly. And, getting to this global financial stability, I think that's what a lot of the bankers and regulators think about. I think you have to take it seriously and know that's your objective and potentially limited in some cases.
Another question, you talked about reduced compensation, reduced wages for the analysts. So who's getting the rent that AI is extracting?
Yeah, so that's a really tough question on who's getting the rents. I think it's these companies. I mean, the valuations that I'm seeing for some of these AI startups is just through the roof. And maybe that was just all the money that came in VC throwing money at it. And so, and we see it's not just here. I mean, I think also in the housing markets, people were looking at like Redfin, Zillow, all of this stuff. People where, it's a housing, it's a matching game. You had a broker and all of this stuff, but there's still value that they brought. And so should the rents necessarily go to software that was written at a point in time? And there's bigger questions about that too, even in the innovation patent space of should AI be able to be patented? If not, who's the inventor on this? How much AI assist can there be? And these end up being questions that are really, I would love clarity, because I think if you gave more clarity to it, and hopefully it doesn't have to go through the courts of regulation, I think then you have this even greater boost to innovation. And so, back to your question, because I do know that I got slightly off topic, I do think that AI is bringing rents mostly to sort of the VC investors, the startups. The hedge funds have done well, some of them. I think this has been actually one of those interesting things where the hedge funds have split themselves more so than in the past. There was a lot of people who were good, and now it's sort of you're seeing some people who are really amazing and some people that are not so much. So, but do I think it's all together too? I guess that would be my final thing. We've seen this resurgence in active management post COVID. I think this all goes together. This changing nature of the analyst job, going back to asking them questions, realizing that our risk models broke during the pandemic. So we need some active management. We can't all just be in the same ETFs with the same institutional investors. I think they're all going to go together and hopefully create value that then ultimately, you would hope ends up going down to more people than just those that are starting businesses and early investors in the businesses.
You did say that your work is based on analyst forecasts, your analysis is based on analyst forecasts. How do you see the adoption of AI in other areas of finance, such as you just mentioned venture capitals and private equity, where maybe less hard data and more data is available and more soft skills are necessary?
So I think those ones will be really interesting to see. I have not seen a lot of applications for private firms. I know of one startup that I had briefly talked about that they were trying to do better valuations for private firms. At this point in time, I haven't seen much there. I think this then goes back to transparency. We don't disclose a ton of information, and I know some people are like, "Oh, disclosure is bad. It has all of this other side effects." But it's also true that investors don't know a ton, and so I do think that people are starting to rely, especially right now. You might think equities are a little frothy, or maybe not, and you're wanting to look at these alternative asset classes. I think that this is then where Robinhood was one to start and basically bring options, but you have a bunch of other ones out there who are giving you exposure to now private equity because they're basically pooling together investors that they might not have brought in before. And so I know one of my colleagues doesn't love when I use the word democratization of the investment land, but I do think that that's what we are doing. I think you're pulling in investors that you had never had before. And so there is a little bit of a fight back that this isn't all going to the top 1% or 10% of the population.
One last question, if you don't mind. Many of your previous papers, academic papers, they're on corporate culture.
They are.
I just saw some work in progress called AI augmented culture and leadership. So I think you're also linking this AI concept with culture. Maybe it's a broad question, but in a nutshell, what are some questions you're asking there?
Sure. So this stuff I'm really excited about. And so, just because of data, we have these companies out there that are doing a ton to basically get surveillance level data or granular data on employees to measure their productivity. But what's really cool, I don't know if you guys have the app called Noom. I'm sort of a health nut. I like to use it. It gives you recommendations, but it's the same idea. You're getting AI-based recommendations during the day to help you. Maybe, you're a person who spends too much time on email, or maybe you just need to get out of your bad habits. Okay. And so what the AI is helping to do is to improve or give you recommendations to improve your performance. Well, one of the key questions I have about this is sort of the culture. How much is it about teamwork versus individual forecast improvement. Google did this amazing project where they looked at all their teams and analyzed them, and they found that the only thing that determined team productivity was not about selection of who was on the team, but was about the cultural norms that improved the team. And so we are using randomized controlled trials to sort of vary the individual versus the team aspect of it. And so, about collaboration or about better communication and trying to understand if these recommendations are working. But I do think that this AI getting into sort of leadership and things that we always thought of as not what AI can touch, it's there. I know big firms that are already adopting it, and I think it's just going to grow because the hybrid workforce. If you're working from home 2 days a week, employers are scared to death you're slacking off. Okay, so if that's what's happening, they want this surveillance data. They want a way to know that it's going to work. But without the office space, how do you promote a culture? And so these are a lot of the questions that I'm seeking to understand and want to hopefully make. My goal, why I wanted to be an academic, was I wanted to see better workplaces in the future. And so I think that it's going to be possible. We just need to understand it. I can't hear you. Okay, thank you.
Sorry. We're eager to read about your future work on those questions. And again, thank you for participating in our webinar organized by Sabancı University's Center of Excellence in Finance, sponsored by Akbank. And thanks to all our attendees. And we will share a subtitled version of this webinar in our social media platforms in the upcoming days. Thanks a lot, Professor Grennan.
Awesome. Thank you so much for having me. Really appreciate it.
We also take care.